Are you a DAFT recipient and you're looking for some tax advice to help you understand all of the different types of taxes you're going to pay on your income when you're living on the Dutch-American Friendship Treaty? Hi, I'm Christie DuChateau. I'm from BNC Tax Accounting, the largest boutique U.S. tax firm in the Netherlands. And today I'm going to break down the Dutch-American Friendship Treaty for you and explain all of the different types of taxes you'll pay when you're living as a resident of the Netherlands. So a little background, the Dutch-American Friendship Treaty is a reciprocal visa program that the Netherlands and the United States allow entrepreneurs to move to the other's country under a certain number of conditions. This is a visa stipulation, but it does have certain income tax consequences. If you're a recipient of the DAFT visa, then you have a choice to make on which kind of company you want to start in the Netherlands. You can start either a ZZP, which is a self-employed entity, or a BV, which is a corporation. Let's start with the simple version. The ZZP is similar to a sole proprietorship in the United States. The first thing you need to do is register with the Chamber of Commerce. This is a really simple process with a low application fee. Once you're registered, you have your business, and all of your profits of your company are passed through income to you on the personal level. You're not on payroll, you're not an employee, you just have the profits passed through. They get taxed at the personal level in box 1 on the Dutch income tax return. There are some specific tax benefits along with being a ZZP. For example, in the first couple of years of doing business, there's a portion of the income which is not subject to tax. And as long as you meet certain small business rules, there's another portion that's not taxed continuously. Without going too deep into the taxation of the ZZP, that's the way that it works. It is a pass-through entity. The BV is completely different. When you have a BV, you are a shareholder of a corporation. The BV structure allows you to be hired as an employee. So the BV will be its own separate entity, which has a corporate tax filing requirement in the Netherlands, and you will be a shareholder and an employee. As an employee of your BV, you're considered a managing director. You're required to pay yourself a minimum salary out of the BV, and the BV construction under the DAFT visa program may allow you to apply for the 30% ruling. The 30% ruling is a Dutch tax advantage for companies who are looking to hire employees from abroad. It's a ruling that your employer, which is your BV, will apply for on your behalf. And if they get it, then you can get the 30% ruling, which applies to your employment income. Okay, so let's break it down. If you have a ZZP entity, all the profits of your company are subject to tax on the personal level in box 1. Some of those profits will remain untaxed because of some discounts that are provided to sole proprietorships, but that's the only tax that's going to apply, Dutch box 1 tax. If you have a BV, you have 3 different types of taxes that will apply. The corporation itself will be subject to corporate income tax. Corporate income tax in the 2025 and 2026 period are 19% of the profits of the company. That's after considering things like your expenses and your own salary. So that's the first level of tax you're going to pay, the corporate income tax. Then you have your own salary as an employee. Your employment will be subject to personal income tax back in box 1. And if you have the 30% ruling, only 70% of your income is going to be taxed in box 1, your wage income. So it's called the 30% ruling because 30% of your wages are not taxed. The final piece of your income, if you are a BV shareholder, is dividends. Dividends, it's the amount of money that you're allowed to take out of your company after you've paid your corporate income tax. Once you have paid the corporate income tax, you have retained earnings in the company, and at the shareholder level, you're allowed to distribute those retained earnings as dividends. When you distribute a dividend to yourself, that dividend is going to be taxed in box 2 on the personal level of the Dutch tax return. I'll show an example of how this works later in the video. So we have 3 types of taxes being paid as a BV shareholder, and you have 1 type of tax being paid as a ZZP owner. Hope this explains a little bit of the difference of the taxation of the BV and the ZZP. The next part of the video will be showing the tax rates. Here's a simple tax calculation in the situation of a DAFT visa holder who has a BV with a 30% ruling. And I've oversimplified this, but essentially what I've done is given 4 columns, which each show the calculation of all taxes being paid by this taxpayer. This, of course, does not consider anything else about their personal situation. This is just based on the profits of the BV and the salary and dividends payable to this taxpayer. So with a profit of 300,000 euros, and I choose this number specifically because it covers the highest salary that you're allowed to pay yourself with the 30% ruling. So let me show you what I've done. The profit of 300,000 euros, you can choose to have a variable of different salaries. The minimum salary requirement for somebody with the 30% ruling is 66,700 euros for 2026. This is an estimate because the 2026 numbers are not actually published yet, but when they get published, then we will update this formula. Salary range can be minimum 66,700. I used a couple of other numbers which are commonly seen by DAFT shareholders, 75,000 or 100,000. And the max salary you can have and still get the 30% ruling to apply across the salary is 246. That's the only thing I've changed within this particular calculation, how much salary is being paid out to the shareholder. So assuming they have the 30% ruling, only 70% of the salary is taxable. On the personal level, in box 1, the taxpayer will pay this line here, income tax. So their net salary between the salary that they're paid and their actual take-home pay is listed here. So here's the take-home pay at each of those salary levels for the individual. Now this salary is an expense of the company. So to get to the corporate income tax, we have the profit minus the salary equals the profit before corporate income tax. The corporate income tax ranges between 19% and up to 25.8%. If your profit's more than 200,000, then anything over 200,000 is at the 25.8%. So here's the corporate income tax at these profit levels. Once you've paid your corporate income tax from your profits, you have a retained earning balance as a shareholder. Those retained earnings can be used to pay out dividends. So if we're trying to figure out what is the maximum tax responsibility of this taxpayer, we're assuming that they pay out the entire retained earnings as dividends. Now, you don't have to pay out your entire retained earnings as dividends, and that's where the strategy comes in. But let's consider what the max tax rate is. So we consider that we pay out all the dividends. Dividends also have 2 tax rates. Dividends up to 67,000 for 2026 are expected to be at 28.45% up to 67,000, and anything above that is going to be taxed at 36%. So dividends, in the case of this taxpayer at several different salary levels, the dividend is higher when the salary is lower, and the dividend is lower when the salary is higher. So here's the net dividend after they've paid their dividend tax. The total net cash that comes out to this taxpayer is the total of their net salary plus their net dividend. In this case, your net cash goes up when your salary is high and your dividends are low. And the reason for that is because of the 30% ruling. A lot of income is being not taxed when you have the 30% ruling. So you want to get your salary up as high as possible to reduce your overall tax rate when you have the 30% ruling. In this case, the effective tax rate when the salary is high is 33%. The worst effective tax rate is actually in between here, and this has to do with the general tax credits and the tax rates at different salaries. So because, without going into each and every one of the numbers, if you pay yourself a $75,000 salary, you actually have worse off taxes than a $100,000 salary. Now to compare that to a ZZP, a DAFT visa person who has no 30% ruling, If you're on the DAFT visa, you don't pay corporate income tax, you don't pay dividend tax. The only tax you pay is your box 1 tax. If your profit's $300,000, you have some discounts, so not all of that profit's going to be taxed. And in the end, your net cash is $182,000, which is really not that different from somebody who paid themselves a low salary and a high dividend. 181, 180,000, or the tax rate, effective tax rate is between 39 and 40%. But do try to remember that there is a cost to the extra filing obligations when you have a corporate entity. So when you do have the BV, you have to pay for more accountants, notaries, advisors, you have to pay for payroll, corporate tax return, etc. So your total take-home cash might be slightly lower with the BV once you've paid all of those advisors. The ZZP is a pretty simple setup. So this is an example of what the tax rates look like when your income is relatively high for the Netherlands. But often I hear, well, what's the break even? What about if I make 100,000? People talk about this 100,000 number that's very magical. Let's look at it with 100,000. So with 100,000 profit, and again, I did the same salaries, I just dropped off the high one because we don't have that much money here. If you have the BV with the 30% ruling, your salary is only 70% taxable. Same thing, you've got your box 1 tax, there's some credits which phase out, and so the net salary is in this line here. Your corporate income tax is the same, we're only using the 1 rate because it's below, our profits are below 200,000, so we have the lower rate, and we have some retained earnings which are allowed to be distributed as dividends. The dividend tax is going to be also at the lower rate, 28.45% for 2026. And in this case, our effective tax rate is much lower. Same thing happens here. We have the lowest possible effective tax rate when our salary is high because we are taking so much of our money as untaxed. So that is the best method when your profits are around 100,000. Let's look at the ZZP. ZZP has, again, a haircut. They don't have to pay tax on their entire profit. So we're here, you're paying tax on only 70,000. If you take the ZZP model, you're paying tax on 83,000, and your tax rate goes up to 26%. So this does show when you have the 30% ruling, if you're making 100,000, it is more tax advantageous to have the BV. However, when we look in absolute numbers, the net income that somebody is receiving here as ZZP is 74,000, and here the highest possible is 77, almost 78,000. The administrative costs of running the BV can very frequently be more than 3,000 extra euros between all of the notaries, accountants, payroll, corporate income tax filing, etc. So your take-home pay might end up being slightly less with the BV because of all of the extra fees involved. All right, I hope I've explained the difference between the BV and ZZP and a few different tax scenarios well. Please leave some comments and let me know if you'd like to see more.